Hello guys, once again this is Mr. Maxwell bringing you another piece of valuable content, taking a deep dive into IULs, Index Universal Life. We're touching on MECs, MEC, the Modified Endowment Contracts, and we're also going to talk a little bit about insurance companies and how do they get paid, how do they stay in business. So we're touching on that a little bit as well, giving you a little bit of inside information of how things work. Without further ado, Marla Redrick and Ahmad McCarroll.
Okay, in order to define index products, we have to first go back and talk about what is an index. So, and we only have a few minutes here. So here's what I will tell you: an index is like the S&P 500. An index is like the Dow Jones, the Nasdaq. Those are indexes. Those indexes are going up and down every minute of every day, right? And so those are indexes. They're unmanaged. They're what they are. So take, for example, the S&P 500. Those are 500 of the top companies in the United States. And you know, we can name a few: Tesla, McDonald's. I can go on and on and on. And so those are indexes.
If a person was to invest, what options would they have? If you guys are finding value in this content, don't hesitate to like, subscribe, or share. Leave comments. Ask questions on what you would like to see, what you would like to know in the future, what type of content you would like to see in the future.
So that's an interesting question, because so you can purchase parts of an index. You can purchase part of the S&P. You can purchase part of the Nasdaq, which is why, Marcus, you may have some people that are losing money in the market.
Oh my God, did you hear what happened? I know you know what happened today.
God, Black Monday.
So Black Monday.
Right.
So for those of you who are watching, if you invest in the market, I'm sure you know exactly what we're talking about. And indexes would be a way to perhaps avoid this flutter of butterflies that people have,
Absolutely.
or gloom and doom that they have in relationship to the market right now.
Right, because what we're talking about is products that kind of mirror the indexes, but without the downside, without the loss.
So that would have been the thing that I would have said. While he was talking about it, I definitely didn't want to interrupt Armand, but just to say that it really mirrors the market rather than being in the market. So indexes, basically, like if I were to take a look at something and I say, okay, that looks good, okay, that's good, I'm gonna roll with that. And that's really what the indexes do. They look at the market, like you said, the Dow, the Russell, the Hang, different indexes, and they see, okay, it's doing good. Let's roll with that. In other words, they increase when the market increases very often. But the thing that makes them different is when the market goes down, then the indexes do not participate in the down part of the market. They basically kind of hold steady and do not participate in the loss part. Like today being Black Monday, some stock markets are at a zero, things like that. I know I looked at some things that I have, and they're negative right now. Indexes never go negative.
Okay, now this is a two-part. So for those who are not sure, and we want to make it clear that this is actually defined as an insurance policy, right? But this is just one component of.
So here at Advantage, the products that we're talking about when we say index products, we're talking about indexed annuities, which are insurance company products, and indexed universal life products, which obviously are insurance products. So those are the ones that we're talking about.
Okay. And
we need to define what annuities are and then what life insurance.
that would be good.
Okay, so These are permanent life insurance policies. You know, you only have two kinds. You have term and then you have permanent. One of the permanent types of life insurance is indexed universal life insurance. It provides all kinds of benefits along with living benefits, along with death policy or death benefits, and then does a couple of other things that would take too long to explain in this video, right?
Don't forget about the cash accumulation.
I didn't want to.
Yeah, I know.
I didn't want to go down that because I would love. Really, we can do a whole separate video on that, and actually, we did do one. We talked about cash accumulation before in the other
we
video.
touched on it.
Inside of the IUL, they
Yeah.
go back and look at that other video.
Yeah,
right?
They
go
can.
back and look at the IUL video. That'll help to explain some things. But then annuities are very much like pension plans. They basically set you up so that you do not outlive your money, and so it takes your money and houses it inside of an index product or the index the index strategy, and then helps your money to grow so that when you get to a certain age, then you can get distributions on, say, a monthly or annual basis that will help to sustain you throughout your life. And so that's what an annuity really does. It helps you to not outlive your money, if you will. Does that make sense?
Yeah, so basically it sounds like you're saying that an annuity is basically a entity that houses and accumulates funds for a later dispensary at retirement,
Absolutely.
either for the rest of your life or for a term.
That's right.
Correct.
Can you take that same annuity and say dispense it somewhere else? Say you want to use that annuity for a college fund for your kid or for your wife or
So, you
No,
want to
go
go
ahead.
ahead?
No, take it.
So you can absolutely use it however you want to use it, but that's not the real goal of a annuity. The goal of an annuity is to really set it up so it can have a regular distribution. What you do with that distribution is totally up to you. You might use that distribution to fund college, to provide retirement supplement. You may use it to pay your taxes every year. Whatever you use it for is totally on you, but it's usually set up to distribute on a regular basis. Now, will you get to a point where they'll tell you to take the part of the distribution? Yes, absolutely you will. And that is going to be that magic age of age 72 when you're going to need to start taking regular distributions. But again, that's probably another video as well, but we want to be brief. So hopefully that answered your question.
what are the advantages of having an index as opposed to people who lost? What are the advantages of having this particular one?
So that's a great question. So one of the advantages is kind of like I mentioned before. You get all the upside of the market without the down.
How can they structure, how is it that they are able to structure this,
That way,
yes,
Good
without
question.
a loss?
That's
Good
a
question.
great question.
insurance companies are in business to make money. Let's not get it twisted. And so if you look at the history of different markets, let's take the S&P, for example. If you look over a 40-year period, the S&P has done somewhere between 7 and 10%.
Yeah.
Somewhere there over the last 40 years. Insurance companies know that. And so what they do in these index products is they give you what they call a ceiling or a cap. And that ceiling or cap may be 7, 8%. And so what that means is over the life of that annuity, at least while you have it, that's the max you will be able to earn. So what if the S&P does 20? But you're guaranteed 8, who gets the rest?
So,
Insurance company.
And so that's how they make their money. So, and people love them because they also, in addition to having a ceiling, they also have a floor. And that floor is what? 0.
Sometimes there are
sometimes a little bit more.
Yeah, sometimes there are products that might be 1% or 1.5%. So they do sometimes, to be competitive, different companies will offer a different floor, but you always have a floor and you have a ceiling. And that ceiling allows the insurance companies to make that overage and then support you when the market goes down, because again, you're not going to participate if the market goes -6 or -8. They're not gonna take any of your principal away from you. They're going to just keep you at that floor level, which will be that 0 or 1%, whatever they've promised.
Can you guys explain the different types of indexes? Meaning, there's one where once a person passes on, I don't know how to put it. Once a person passes on, there's nothing else paid out. Then the other one where, can you guys explain the different types of annuities there are? And how many types are there?
So there are many types of annuities, but let me just go with the most popular one. So you got a single premium annuity, which means you put in one lump sum. So, if you have an old 401k and you want to roll it over into an IRA annuity, we would probably use a single premium annuity. That's also included in something called a deferred annuity, which means you put the money in, it stays there, it grows, and then at some point, like Marla indicated, in the future, you start taking distributions from it, and it's growing and it grows. So, glorified pension plan, if you will.
And that might be anywhere. You might just it might be 3 years, 5 years, 7 years, 10 years, and that is the time period that the money is actually growing in the investment product.
Because, again, we could do a whole video just on the types of annuities. There's also annuities called SPIAs. Now, we use SPIAs when, let's say, you just won the lottery.
Or got an inheritance.
Or got an inheritance.
What does that stand for? Is that an acronym?
Premium immediate annuity.
Okay.
And so what that means is we take that lump sum, let's say you got $1 million, we take that lump sum, put it in the annuity, and we start paying you income right away. That's an immediate annuity. So there are many different types. Either way, we can, what we do is we figure out what's the best thing for the client, and then we go out to our companies, bring that product to the client so that we know it's the best thing for what you need.
So we are designers. We're just financial designers. I like that too. So we make a decision as to what looks good on you, what's going to fit you the best, what's going to pay you the most, what is going to satisfy your dreams and aspirations as you move through this journey called life. We generally do not do annuities that won't pay you anything. You have annuities that are, you're talking about the pension
plans on the job.
Yeah, pension plans,
10-year circle.
or a plan that is going to pay you,
said.
Right, that's going to pay you for life, and then it cuts off after your life is done, and it doesn't pay your beneficiaries absolutely anything. We don't have too many. I can't even think of any products. So they're out there, but Vantage doesn't really offer too many of those kinds of programs.
The products, like Marla said, the products that we market typically have beneficiaries. And so no matter what happens, when the insured or the annuitant dies, the rest of the money goes to their beneficiaries.
So we don't write those other plans.
Yeah.
So,
we don't. Okay.
So I would imagine, like, I want to go back to what Armand said, which was we design a product for you. So if you tell us, I have other money set aside for my beneficiaries, I want this to strictly be during my lifetime, can we give that to you? I'm going to say yes, we can, because we can design whatever it is that you want. Would that be the best plan for you together? You, myself, or Armand, or even you, Marcus, whoever they're talking to, whoever their financial planner is. And sometimes we collaborate. Sometimes you get the benefit of all three of us. And it gives you an idea of exactly what it is you need.
Anything else you guys want to add?
So yeah, just to kind of wrap it up, the reason why we wanted to put this video out is that certainly today, being Monday, August the 4th, August the 5th, Black Monday, there's turbulence in the market. We just want people to know that there's an alternative to them losing money in the market, and we can help you with that through various index products. So that's really the purpose. That's what we wanted to let everyone know.
To let people know there is a safety valve.
There is a safety net. You don't have to have all of your money at risk of losing. You can have a portion of your money that is protected.
So, and to conclude with what Armand is saying, I know some people like to gamble. I'm just going to be real. I know some people love to play the stock market. They enjoy their cryptocurrency. They just enjoy seeing the money go up and down and the excitement of winning and the sadness of losing. But you should always have a portion of your money that isn't in a volatile market, that isn't at risk when we have another Black Monday, and it will come again.
Absolutely.
What would you say to the real estate investors that say, do I really need this?
So let me just say this. I've been around long enough to experience the real estate crash of 2008. And matter of fact, I had a lot of real estate during that time. I would have loved if I had $500,000 sitting in an indexed annuity or an indexed universal life that I could have used to start purchasing property after 2008. And so absolutely, positively, yes.
What do you tell people that say, hey, I got a decent bank account? I mean, what's the difference?
So what I would ask you is, are you familiar with inflation?
Yes.
Are you familiar with taxes? And what are you losing by having that money sitting in that bank account when it's not earning a good rate of return?
Or keeping up with
inflation. And you got to pay taxes on it.
Yeah.
When we put that money inside of one of these other products, and again, let me preface it, we're not CPAs, we're not tax accountants. But so, anything that we tell you, check with your professional. Mm-hmm. But what I can tell you is that money inside of a non-qualified annuity goes tax deferred. So you don't have to pay any taxes on that money until you take it out.
And with an IUL, if you have an index product, an IUL, then your money can be in a safety valve where you do not have to pay taxes. If you withdraw that money, as long as you stay under the MEC, which is the Modified Endowment and Contract, Modified Endowment Contract, MEC. If you stay inside of that, then you won't pay taxes on that either. Not for total withdrawal now. We're not talking about total withdrawal. But if you're borrowing the money and your plan is in the future to put that money back, there's no taxes.
If you're interested in joining the Vantage team, or if you're interested in learning more or a free consultation about the products we offer, feel free to click the link below. Someone will be in touch with you within 24 to 48 hours. Thank you for tuning in. This is Mr. Maxwell. Stay tuned for the bloopers and outtakes. Can you touch a little bit more about exactly what the MEC is?
Well, the Modified Endowment Contract basically is the agreement between the IRS. See, what people don't understand is that an IUL is actually a tax code, So you have the 7702A, which is a tax code. So basically the IRS has given permission, if you will, for people to keep their money inside of an IUL and not be taxed within a certain limit. They're saying, okay, we understand that you're doing cash accumulation, and that cash accumulation could benefit you in the way of long-term care, other living benefits, being money that you can borrow without having to pay for, pay outstanding funds for it, being able to utilize that IUL for positive things. And so they've given permission, and many rich people actually put their money inside of an IUL because it doesn't have a lot of the limitations like, say, a Roth. A Roth has limits, but you can't do that with a Roth. You can't just put money in, take it out, put it back, and so forth. But this allows you to do that, and so it's a tax code, and the IRS is basically giving permission for you to be able to utilize an IUL in some of the same ways that you would utilize some other vehicles without running into taxes. Now, you have to be very careful about those limitations, and the insurance company helps you with that. They'll send you notifications if you put more money than is allowed by the IRS. So I guess that pretty much.
But that, I gotta say, and we kind of covered this in the last video, that's where a knowledgeable insurance professional comes in that can help you structure your product for you,
That's
as
true.
Marla indicated. And so make sure that you have someone that understands your goals, what it is you're trying to accomplish, and also understands the MEC laws and 7702, and that way they can put together a plan that's right for you.
I heard somebody say today, relationship is everything. And, we're the people that you want to have a relationship with. I mean, in my opinion, you want to have a relationship with your attorney, with your tax consultant, with your
doctor.
your doctor,
Yeah.
your insurance professional. I mean, for sure. Be in that position where you know who you're dealing with and they know you.
All right, guys. Thank you for that. That was a lot of information
Yes.
in a little bit of time. And we look forward to you guys coming back for the next one.
All right,
Thank
sounds
you.
good. Thank you, Marcus.
All right, we have Marla, the team leader and marketing director. We
You are a team lead.
also have, see, we're going to have to, I would just keep it recording.
Go ahead and edit it. Just start over, man.
Oh,
Okay,
man.
So marketing director and team lead Marla Redrick. Marla.
Redrick.
Okay.
Redrick.
Redrick.
Maybe I should do, I'll just do a separate
A
introduction.
little intro, like you
Yeah,
did. That's what I thought. Yeah.
like I did
Go ahead,
last
you
time.
do it. You get to turn the camera around.
Y'all want to see?
You better leave him alone. He know how to do his thing.
Okay,
now.
do your thing, baby. Do your thing.